Good day, everyone, especially to you, Dr. Jeah. My name is Jeah Rojo, and today we're going to talk about the topic 10, which is the financing the enterprise. So first, before we proceed, let me provide to you the objectives for this topic. First is to identify and differentiate the steps in bookkeeping. Second is determine the content and importance of financial statements. Third, identify the different tools for analyzing financial statements. And lastly, explain the fundamentals of taxation. Bookkeeping refers to the systematic process of recording, organizing, and maintaining financial transactions. It is a foundational activity in financial management that involves the meticulous entry of all business transactions into a structured set of accounts. So here are the process of bookkeeping includes several key activities. First is recording transactions. This involves documenting every financial transaction such as sales, purchases, receipts, and payments into appropriate accounts. Next is the maintaining ledgers. The ledger is a central repository where all financial transactions are categorized and summarized. Lastly is reconciliation. Regular reconciliation involves comparing the business records with external statements such as bank statements to ensure that all entries are accurate and complete. Record keeping. It encompasses the broader practice of managing all types of records related to business operations. While bookkeeping specifically deals with financial transactions, record keeping includes a wide range of documents and data, both financial and non-financial. So here are the effective record keeping involves. First is documentation, keeping detailed records of various business documents such as invoices, receipts, contracts, and correspondence. Next is organization, structuring records systematically to facilitate easy retrieval and reference. Next is retention, ensuring that records are kept for the required duration as per legal and regulatory guidelines. Accounting. It is a broader discipline that builds upon the foundation provided by bookkeeping and record keeping. It involves the process of summarizing, analyzing, and reporting financial information. So here are the key components of accounting. First is we do have financial statements. Accounting involves the preparation of financial statements, which include the income statement, balance sheet, and cash flow statement. Next is financial analysis. Accounting includes the analysis of financial statements and data to assess the financial health of the organization. Lastly is compliance and reporting. Accountants ensures that financial reports comply with accounting standards and regulations. This includes preparing reports for stakeholders such as investors, regulators, and tax authorities. So the role of accounting is to provide a clear and accurate picture of a business financial status. So we do have 6 accounting process, which involves a systematic series of steps that ensure accurate and meaningful financial information is produced. These steps transform raw financial data into insightful reports that guide decision making and ensure compliance with accounting standards. First is analyzing. The first step in the accounting process is analyzing financial transactions and events. This involves examining the nature and impact of transactions on the organization's financial position. Second is recording. Once transactions are analyzed, they need to be recorded in accounting system. This step involves entering the transaction details into journals and ledgers, ensuring that all financial activities are documented accurately and timely. Third is classifying. After recording, the next step is classifying the transactions into appropriate categories. This involves organizing recorded data into specific accounts to facilitate easier tracking and summarization. Fourth is summarizing. It involves consolidating and summarizing the classified data to prepare for financial reporting. Fifth is reporting. The reporting step involves presenting the summarized financial information in the form of financial statements and reports. These reports communicate the financial status and performance of the organization to internal and external stakeholders. And lastly is interpreting. The final step is interpreting the financial records to gain insights into the organization's financial health and performance. This involves analyzing the financial statement to understand trends, assess performance, and make informed decisions. So here are the basic financial reports. First is the income statement, or also known as a profit and loss statement. It provides a summary of an organization's revenues, expenses, and profits or losses over a specific period. First, the components of it is that we do have revenues. It is a total income generated from sales of goods and services. Next is expenses, which costs incurred in generating revenues, including cost of goods sold, operating expenses, and interest expenses. And next is net income, which is the difference between total revenues and total expenses, indicating the profit or loss for the period. Second is the balance sheet. The balance sheet, or also known as a statement of financial position. It provides a snapshot of an organization's assets, liabilities, equity at a specific point in time. So the components of it is assets, resources owned by the organizations that are expected to provide future economic benefits like cash, accounts receivable, inventory, and properties. Next is liabilities, obligations or debts owed by the organization to external parties like accounts payable, loans, or accrued expenses. And lastly, there is equity, the residual interest in the assets of the organization after deducting liabilities, representing the owner's claim on the assets like common stock and retained earnings. Next is we do have cash flow statement. So it provides information about the cash inflows and outflows from operating, investing, and financing activities over a specific period. So the components of it is operating activities, cash flows from the core business operations, including receipts from customers and payment to suppliers and employees. Next is investing activities, which cash flows related to the acquisition and disposal of long-term assets such as property, equipment, and investments. And lastly, financing activities, which cash flows from transactions with owners and creditors, including issuing or repurchasing stock, borrowing, and repaying loans. Next is a statement of changes in equity, or also known as a statement of retained earnings. It shows the changes in equity accounts over a specific period of time. The components of it is first, beginning equity, the equity balance at the start of the period. Second is the additions, which contributions from owners such as additional capital or issuance of stock. Third is deductions. These are the withdrawals or distributions to owners, such as dividends or repurchase of stock. Fourth is net income, the profit or loss for the period affecting retained earnings. And lastly, the ending equity, which is the equity balance at the end of the period. So we do have also other essential documents. First is we do have journals. Journals are chronological records of all financial transactions, including detailed information about each transaction such as date, amount, and description. Next is ledgers. So ledgers are detailed records of financial transactions categorized by account. So each ledger provides a summary of all transactions related to a specific purchase or transactions. Next is we do have trial balance. The trial balance is a report that lists all ledger accounts and their balances at a specific point in time. It is used to verify that total debits equal total credits. Next is we do have bank reconciliation statements. Bank reconciliation statements compare the organization's bank statement with its cash book to identify and reconcile differences. And lastly, the invoices and receipts. These are documents issued to customers requesting payment for goods of services, while receipts are proof of payment received. So we do have the users and uses of financial statements. First is investors. Investors, both current and potential, use financial statements to evaluate the attractiveness and risk of investing in a company. Next are the employees. Employees and their representatives use financial statements to understand the company's financial health, which impacts their job security and compensation. Next are lenders, including banks and financial institutions, which use financial statements to evaluate the creditworthiness of a company before extending loans or credits. Fourth are the suppliers. Suppliers and vendors use financial statements to assess the reliability and financial stability of a company before engaging in business transactions. Fifth is the customers. Customers, particularly those engaged in long-term contracts or large transactions, use financial statements to assess the reliability and stability of a supplier. Sixth are the government agencies. Government agencies use financial statements to ensure compliance with regulatory requirements and monitor financial practices. Seventh is public. The general public, including analysts and researchers, uses financial statements to gain insights into a company's performance and impact on the broader economy. And lastly is the management. Internal management uses financial statements to make strategic decisions and manage the organization's operations effectively. So next are the special journals. They are used to record specific types of transactions that occur frequently in a business. They streamline the accounting process by grouping similar transactions together, which simplifies data entry and improves efficiency. So here are some common types of special journals. First is we do have the sales journal, which is used to record all credit sales of goods and services. It helps track revenue from sales made on account. Next is the purchases journal. It is used to record all credit purchases of goods and services. It helps in tracking expenses and accounts payables. Third is we do have the cash receipts journal. It is used to record all cash inflows such as payments received from customers. It helps manage cash flows and tracks receipts. Fourth is the cash payments journal. It is used to record all cash outflows, including payments made to suppliers or for expenses. It helps manage cash disbursement. Lastly is the general journal, which is used to record transactions that do not fit into the special journals or require adjustments. It serves as a catch-all for less frequent entries. Next is the subsidiary ledgers. Subsidiary ledgers provide detailed information for specific accounts within the general ledgers. They complement the general ledger by breaking down aggregate account balances into more detailed records. So here are some common types for subsidiary ledgers. First is we do have the accounts receivable subsidiary ledger. It tracks individual customer accounts and outstanding invoices. It provides details on each customer's balance and payment history. Next is we do have accounts payable subsidiary ledger. It tracks individual supplier accounts and amounts owed. It provides details on each supplier's balance and payment status. Third is inventory subsidiary ledger. It records detailed information about inventory items, including quantities and costs. It helps manage inventory levels and costs. And lastly, the fixed assets subsidiary ledger. It tracks individual fixed assets such as equipment or buildings, including their cost acquisition, depreciation, and disposal. So the interconnected processes of bookkeeping, record keeping, and accounting are vital for effective financial management in any enterprise. Bookkeeping systematically records financial transactions. Record keeping manages a broader range of business documents for compliance and efficiency, and accounting builds upon these foundations by summarizing, analyzing, and reporting financial data to provide meaningful insights for strategic decision-making and ensuring transparency to stakeholders. By following the systematic accounting process, analyzing, recording, classifying, summarizing, reporting, and interpreting, organizations ensure accurate financial reporting, compliance with regulations, and support for informed strategic planning. So that would be all for my report for topic 10. I hope you have learned something. Thank you so much for watching and have a great day.